Welcome. Happy Friday, valued members of San Diego City Employees Retirement System. We serve the employees and retirees of the City of San Diego, the San Diego County Regional Airport Authority, and the Port of San Diego. And thank you all for your service. And thank you for coming here today to navigate the pension road with us. I want you to think of this as a good old-fashioned family road trip, but I'm the backseat driver. So in order to make it there successfully, I need you all to be engaged stakeholders. Because we're all stakeholders in our pension system, and I'd like to introduce to you some of our key leaders who are here today. We're going to hear from our Chief Executive Officer, Mark Hovey, our Chief Benefits Officer, Marcel Rossman, and our Chief Investments Queen, Liza Krisafi. That's right, that's right. I'd also like to introduce a few of our stakeholders, leaders of our stakeholders who are here in the audience, and if you'll just give a wave when I say your name. We have Joan Hernandez, who is the president of the Ask Me Local 127 retiree group and also on the board of REA. I have Tony Hancock, representing the Retired Fire and Police Association. I have Joe Flynn, representing the Retired Employees Association. And unable to be with us today is a newly elected member of the board. His name is Charles Hogquist, a retired police lieutenant who previously served on the board about 10 years ago. We had a chance to meet with him earlier this week, and I am confident that he will represent you well. Do have someone here who needs no introduction, so I'd like to bring forward the president of the SDCERS Board of Administration, Alan Aralato.
Thank you, Cynthia. Thank you for coming. Just a real quick moments. I'm the active fire member on the SDCERS board. I've been on the board since 2008. And as a fellow employee, I can tell you nothing concerns me more than the security of my pension. And I'm sure that's why a lot of you are here today, or why we pay attention to these things, because we get a lot of inputs as employees, right? That we're feeling like our pension and our retirement security is under attack. Well, I can tell you, as sitting on the board for several years now, we have a very secure pension. Our pensions are safe. As much as we get that rhetoric from the media, you really don't have anything to concern yourselves with in terms of the security of your pensions. As an active member, I have other active members on the board with me, and then a retiree, and then the mayor appoints and is affirmed by council. And I can tell you that 13-member board of trustees is absolutely committed to ensuring that the benefits are paid and that the pensions are secure. As we move forward here, the system's gone through a lot of changes over the years. Some would say good, some would say bad. But as a result of a lot of the changes, our pension system today is winning awards. It's winning awards for its investments, it's winning awards for its governance, and we have truly started to become the leader in this country on pension governance and investments. And that's something I'm particularly proud of, because when I first came on this board in 2008, whenever I would travel to go to conference and get education, it was always, ooh, you're from SDCERS. You're from that pension system. And I think some of you can remember some of the struggles we had in the early part of the 2000s. Well, I can tell you that through all of those struggles, through all those challenges, one thing that has occurred is we know how to do pensions here in San Diego now. We know how to invest, we know how to govern, and I can tell you that the team and the staff here at SDCERS is absolutely committed to that. So thank you for coming. I appreciate you guys coming, and I'll give it back to Cynthia.
Thank you, Alan. So, why are you here? Why? As I said, we are all stakeholders in this pension system, so we all have a job. I believe that you're here because you want to be reassured that your pension system is in great shape and that your benefits are secure. Got that. I also think you're here because you care about your own personal retirement future and you want to be educated and informed. So we've got a program that will explain to you further how SDCERS pension system is solid. We're going to show you how we are leaders in successfully investing for the long haul. We are leaders in pension governance to ensure that your benefits remain secure. And we are leaders in service to our members. So we've designed a program that will address the key issues you need to know about. So listen carefully. This is being videotaped, and after the event, we will have the slides available to you as well as a videotape of the event so you can review it. If you do have questions during the presentation, we have cards that you can write your questions on. Just hold up your hand, and Shawnquana Pemberton, our call center supervisor, or Jessica Packard, our communications manager, will collect those from you and bring them up to the front. Please include contact information on the card in case we need to follow up with you. Okay? So, are you ready? Let's get this show on the road. Here's Marcel.
Good to see you all. I am here to talk to you about some of the supplemental benefits you have available to you at SDCERS. I'm going to start off talking about a 2014 Harvard study that was replicated in 2015 by Microsoft. This study found that goldfish have an attention span of about 9 seconds. It also found that humans have an attention span of about 8 seconds. So really I'm working on beating goldfish today and keeping your attention. So let's talk about some of these things that are supplemental benefits that are important to you. The first one that we get the most questions on, what's going to happen with 13th Check and Corbett? I'm happy to report that staff will be recommending at our board meeting on November 4th that the board, that the board approve the payment of 13th Check and Corbett for this year. If approved by the board, that will be in your November pension checks. The other supplemental benefit I want to talk about today is your COLA, your cost of living adjustment. That normally happens in July of each year, and that's another benefit that is based on external factors. So this is based on CPI and what CPI does. Last year, that was a 0.7% increase. It can be a maximum of 2%, and we'll be letting you know in May of 17 what that will be for 2017.
Good morning. So I'm here today to give you an update on the markets, what our returns were, and some of the things that we accomplished in our investment division for the year. But before I get to that, I would like to introduce the newest member of the investment team, Demetrios Haldas. He is an assistant investment officer, and he's going to be handling a variety of operational audit and CAFR-related duties, as well as learning about every aspect of the investment portfolio. He comes to us from Chicago, and he has an economics degree from the University of Notre Dame. Go Irish. So the first chart I have here gives you a review basically of what happened in the US markets. And as I said, I think the other day, that is not my blood pressure. That is actually the S&P 500, that jagged line. And as you can see, there was a lot of volatility during the course of the year. And there were a couple of major corrections. About this time last year, the Chinese devalued their currency, their market collapsed, that spread to other markets. So there was a major drawdown in the market. In February of this year, you can see, there were additional concerns over global growth, and the price of oil fell to $27 a barrel. Again, another major correction. And then 2 weeks before the end of the fiscal year, which did about give me a heart attack, we had Brexit. You can see that sharp decline right at the end of the fiscal year. And that's where the UK basically decided to leave the European Union. Luckily, we recovered most of that decline. But basically a very volatile year for stocks. And then you can see the green line, which is the yield on the 10-year US Treasury note. And that declined during the year, so the yield at the end of the year was about 1.5%. And that's basically as a result of a lot of uncertainty in the markets. You've got volatility. It's a flight to quality. Investors pile into investments that are considered safe and secure. So people were putting their money into 10-year US Treasuries, and that drove the yield down and the price up. The next slide shows you market returns for a lot of different asset classes. And you can see we had both positive returns and negative returns. You can see US stocks were mildly positive between 2% and 4%. SDCERS' stocks were actually slightly negative during the year. And the reason for that is twofold. One, some of our active managers underperformed their benchmarks. And two, we have a small cap bias in the portfolio. And what that means is we have a heavier weighting in the stocks of smaller companies than the index. And during a period of uncertainty and volatility, those kinds of stocks are perceived as being more risky, and so investors don't like them. Over the long term, that's provided additional return to us, but in a market environment like this, they did not perform well, and you can see the Russell 2000 index, which is small caps, had a negative return for the year. Then the next bar, which is the EFA index, that's developed markets outside of the US, also suffered a lot of volatility, negative return. And then following that is the emerging markets index, an even bigger negative return of 12%. Then you can see US bond returns, the two Barclays indexes, were mildly positive. Then you have the next two bars are emerging market debt. Emerging market debt, the global index, that's dollar denominated. That actually did very well because it's the dollar rallied during the course of the year and those bonds did well. And then you see what the return was for the 10-year US Treasury note. And that again is a function as yields come down, the price went up. So that's an extraordinary return for a 10-year Treasury note. What this does not show you is returns for alternative asset classes. So for private equity, we had a return of 8.5%, and real estate was actually our best performing asset class at 13%. That's why we're diversified. The next slide shows you investment returns not only for the year but for longer periods of time. So the return for the year was subpar at 1.1%. And the biggest driver to that, obviously, was our exposure to equities, both U.S., non-U.S., and emerging market equities. That comprises about 47% of the portfolio. So that was the big component of the return for last year. You can see the intermediate term results, the 3- and 5-year returns, are about 6.8%. The 10-year return at 5.8% still includes the global financial crisis of 2008-2009, where we had big drawdowns. But then if you look longer term, and we are a long-term investor, 20 years, we're at 7.8, and since inception, which is when we started measuring performance, we're at 8.8%. So the long-term results still look good, even though in the shorter term, returns have become more challenging. But I would like to point out, when we look at this chart, this shows you individual returns for the last 18 years. And you can see that we have gone through periods before where you've had negative returns or lower returns than expected. And we've gone through these periods before. You can see the 2001 to 2003 period. That was the fallout from the dot-com bubble. You had 2008, 2009, big drawdowns. That was the global financial crisis. 2012 was actually very similar to this year. It was an election year. There was a lot of volatility. There was uncertainty. Small cap stocks did not do well. It was a risk-off environment. Investors did not want to invest in riskier assets. And then you can see we're 2 years into lower returns. But what do you see about this? Every period where we've had lower returns, look what happened afterwards. You've had higher returns. And that actually presents an opportunity. So we may be in for another year of lower returns, but then one would expect after you go through a period of lower returns and maybe even have a correction that you're going to come up against some better investment returns, better and more interesting investment opportunities. So the message is really you've got to buckle up and ride out the tough times currently and remember that we're long-term investors and that there will once again be positive returns going forward. So some of the highlights for the year, I think I've talked about the first 2 points with stocks being very volatile and the Treasury yield coming way down. But I'd like to talk a little bit about the returns for private equity and real estate. About 6 years ago, we made a significant commitment to alternative strategies, such as private equity, infrastructure, real estate, and some opportunistic strategies. And the theme at the time was go big or go home. And what we meant by that was if you're going to have some exposure to alternative securities, you don't just dip your toe in the pond. You make a significant commitment. We have 27% of our portfolio allocated to these types of strategies. And thank goodness we do, because they have provided great diversification for the portfolio and added significant returns. And then last, the 1.1% return, while it doesn't look that great, actually put us in the top 30th percentile compared to our peers. So what were some of the accomplishments that we did last year? First of all, we completed an asset liability study. And that really is where you're looking at the mix of return-seeking assets, which is 78% of the portfolio, and how that compares to risk-reducing assets, which is 22% of the portfolio, and that's the core U.S. fixed income portion. And we look at that in terms of the assets or the investments we have versus the liabilities, which are the pensions that we owe. And we determine, is that an appropriate mix? And we went through the process and determined that yes, it is. We have a long-term time horizon. We're fully diversified. That continues to be an appropriate strategy. Then we undertook a comprehensive risk review of the investment program. And basically, we're trying to identify risks of running an investment division. And we came up with 9 major categories. And they were things such as asset allocation, diversification, compliance with our policies and procedures, cash management, investment manager selection, to name a few. We talked to a lot of our peers at other public pension plans, and we talked to other consultants and talked about what are best practices. And the conclusion, not only by staff, but also this was reviewed by our consultant, was that we have very sufficient policies and procedures in place to not only monitor, manage, but minimize the risks of running an investment program. Then we added an opportunistic credit strategy. And we basically hired a manager to invest in distressed debt in both the US and Europe. So distressed debt refers to companies whose bonds have had a reduction in price because the company may be facing some financial difficulties. The manager views this as an opportunity to invest in these bonds, which they think are mispriced, and they're not buying the junk at the bottom of the pile. They're buying stuff high in the capital structure where you're going to get paid, and they view that as an opportunity. They have a long-term track record. It's a proven strategy, and they're targeting returns of 10 to 13% net of fees. And then last, we received the U.S. Institutional Investor, U.S. Management Award for Small Public Pension Plan of the Year earlier this year. And that was really recognizing us for all of the restructuring and repositioning that we've done to the portfolio since I came on board and took over, and that we've generated solid returns. So that was a nice kudos. And then last is our asset allocation as of June. And basically, this just shows you that we're well diversified between stocks, bonds, alternative assets. We continue to look for interesting opportunities in the opportunistic bucket that we have there, and that's really where we're looking for things that don't fit neatly in other asset classes, or there might be a dislocation in the market, so it provides some opportunities. We currently have some real estate debt in there, and we have a couple of these credit strategies. So with that, that concludes my comments, and I'd like to turn it over to Mark Hovey.
Thank you, Liza. Did you know that over the last 50 years, Americans on average are living 7 years longer than they were before, and that you're continuing to live longer every year? Did you know that living longer every year is now requiring the city of San Diego to contribute $35 million more into the pension system next year? And the taxpayers are covering 90% of that. And did you know that according to a recent public pension survey issued just last week, that the San Diego system's funding status ranks in the top third of all pension plans across the United States? Very good, thank you. So imagine if you knew how much it was costing city employees for how much they are contributing to the success of the pension plan. Well, you don't have to imagine this, because we've got this figured out and we have a plan to ensure that your system remains sound. So let's get into it and talk about some key trends and what's going on. First, I mentioned people are living longer. This chart reflects a survey that was conducted by the Society of Actuaries a few years ago, and it looks at, on average, how long people are living over a 100-year time span. There's 3 humps there which are sort of hard to make out. There's a smaller hump, a blue one, which shows that 100 years ago, people on average were living to age 72. 50 years ago, which is sort of the middle hump there, shows that people 50 years ago were living on average 78 years. And the tallest hump in the middle of the page there shows that now people are living on average 85 years, and they're continuing to live longer. The actuarial conclusion for this is we need to plan for this, and we need to anticipate that you're going to live longer. So that's good news. You're all doing a great job of taking care of yourself. And yet, our investment returns have not been so good of late. We are a long-term investor. I've talked about that many times at these meetings. We know that we take money in for 30 years while someone's working, and we pay that money into retirement for 30 years. But our recent returns over the last 1, 3, 5, and even 10 years have all been below 7%. And as we look at what is happening going forward, we also expect over the next 10 years it'll be difficult to achieve 7. We do think that's a realistic return assumption, however, and we're just going to continue to work to make that happen. So if we need to anticipate the fact that people are living longer, and we need to anticipate that returns haven't been quite as strong as we would like them, what does that mean for the pension system? Well, pension system is changing. We need more funding, more dollars into the plan. How does that work exactly? How does the money get into the pension plan? Where does it come from? Well, investment returns pay, on average, 65–70% of what goes into the system. And in theory, employees and the employers, the city, the port authority, and the airport, they pay the rest. But in practice, it actually works out that the employers pay more than employees do over time. And it's because of something called the unfunded actuarial liability, or the UAL. So let me give you an example. I just explained that people are going to be living longer. And how that gets funded is active employees for the city, port, and the airport. They will need to be contributing about an additional 1% of their biweekly paycheck into the pension system. So prospectively, that additional 1% is called the normal cost of what employees will need to be paying into the system. And yet, for a lot of retirees, all the past service that you've worked, you're not being asked to pay anything more into the system, which is a good thing. This does not mean retirees need to pay more money into the system, but that does need to be funded. And that responsibility rests squarely on the employers. That's one of the reasons why the employers are paying more than employees. So let's talk a little bit about how much the city actually paid here just 2–3 months ago. This pie chart has 2 slices on it. The smaller slice, which is a blue color, or it's supposed to be blue, hope you can see that, is what we call the normal cost. And again, that's the cost that the city pays each and every year for the cost of employees all working for that period. This year, a few months ago, the city paid approximately $50 million for that normal cost. The other big slice of that pie, the red slice though, that's what we call this unfunded liability, and it represented $210 million that the city needed to pay this year. So why do we have this unfunded liability? What makes that actually happen? Well, there are 3 things that I would point out. One, if you do make benefit assumption changes like we just did on people living longer, that cost primarily gets paid for by the plan sponsors, that past service. That becomes part of that unfunded liability. A second thing is we require our plan sponsors to make their annual pension payments every year. And the airport and the Port Authority have done that every year they've been part of the SDCERS plan. The city has also been paying their bills every year for the last 12 years, but before that, there was a long stretch of time where the city wasn't making their full contribution into the system, and that created an unfunded liability. And then third, as Liza has shared, our investment returns of late haven't been quite at what we expected it to be. That's contributed to some liability. Now, just a little bit more on this one chart, and then I'll flip the page, promise. So this unfunded liability, however, it doesn't stay there forever. That blue slice of the pie is what the city and the port and the airport pay every year, but the unfunded liability does get paid off over time. It's sort of like on a house mortgage. In the city's case, in about 12 years, we are expecting that that unfunded liability will go almost completely away. And for the Port Authority, it's about 9 years, a little bit less time. And for the airport, which is a very well-funded plan, they don't really have much of an actuarial liability. So the good news is that unfunded liability doesn't last forever. It will get paid off. So if that's what the city pays, let's look at the whole funding picture of what money comes into the pension plan. This next chart's actually got 5 different slices of the pie. And now we can come back to investment returns. The biggest portion of the funding that goes into a pension plan comes from investment earnings. Over the past 5 years, SDCERS has generated enough investment income to fund about 54% of the cash that's come into our plan. Then there's 2 slices of the pie right at the top there. One's yellow and one's blue. One says employee, one says employer, and they're each paying about 9%. That's that every year normal cost funding that will always be there. But then the red slice of the pie at the left, that's that unfunded actuarial liability payment, that mortgage payment that our plan sponsors are paying and will so for the next several years. Now, what would that chart look like if once that liability is paid off, that unfunded liability? Well, I can't anticipate the future, but I can tell you what that chart would look like over the past 5 years had we not had an unfunded liability. And that's what this would show. Now, this might look more in line with what you've been thinking would be the normal pension funding model. That shows that employees and employers each pay around 12% of the pie, and the investment returns generated almost 3/4 of the money that goes into the pension system. That's really how the model works over time. So these pension returns are these unfunded liabilities, these pension payments are a little overwhelming, and you're wondering, are we really making any progress? Well, we have made quite a bit of progress over time. There have been over a dozen reforms that the SDCERS Pension Board has put into place to ensure that adequate funding is coming into the pension system. A few examples I've listed here. One of them is that we've lowered our investment return earnings assumption. We've expected and been seeing that less money is coming into the plan from investment earnings, and that's required us to increase contributions coming in from employees and then the employer. A second thing our board has done is we've shortened amortization periods. That's a fancy word for saying what's the length of our mortgage on that unfunded liability I was talking about. We've lowered our amortization period to 15 years, where some other pension systems are using a much longer mortgage period to pay for that unfunded liability. A third thing that we've done is we've shortened the asset smoothing period. That first chart that Liza showed you showed that market returns go up and down very significantly. That can create a lot of volatility in terms of what people need to pay, so we smooth that out over time. But our board has shortened the amount of asset smoothing time we do to put more money into the system. And then finally, somewhat controversially in the past, we lowered our drop interest crediting rates. We did that to pay an interest rate that more closely matches with the length of time over which we're managing those drop monies. That's what the SDCERS board has done, but our plan sponsors have also been busy trying to ensure that plans remain actuarially sound. The city and the port have both introduced new pension tiers that are a little bit leaner, but they also cost less, and I think that's been a good move on behalf of the city and the port. And then finally, the city also has eliminated something called the employee contribution offset, and that's a past practice where the city was paying a portion of the employee's contributions. That has saved the city a significant amount of money over time. Resulting in, we now have more money than we've ever had. This shows what our asset values have been before the financial crisis in 2008 and 2009, and shows our asset balance continuing to grow. Last week, our asset balance was $7.1 billion. That's the highest that it's ever been, and it's continuing to grow. And as I shared at the start of my comments today, there was a study conducted last week, or it was published last week by Milliman, which is a national actuarial consulting firm. And they took a look at the 100 largest pension plans across the United States, and they said, we know a lot of these pension plans use different formulas to measure what their assets are and different formulas to measure what their liabilities are. And sometimes when plans use different methodologies for that, it makes it hard to compare how one plan is doing versus another plan. So Milliman made adjustments to make sure everyone was measuring assets and liabilities on the same playing field. And they said collectively, the SDCERS pension plan was funded at around 79%. That ranks us in the top third of all public plans across the United States. So we're making steady progress to ensure that your pension plan remains very well funded. Next, I'd like to talk a little bit about some pension reforms that have been in the news. Pensions are still in the news. City Proposition B was a measure that was implemented 4 years ago, and as a reminder, this was a proposition that put newly hired firefighters, lifeguards, and general members into a defined contribution plan. A defined contribution means that what money goes into the system is defined, as opposed to what SDCERS operates, which is a defined benefit system, and the benefit is the money that goes out of the system. They work very differently. So this is in the news because it's been subject to a number of legal challenges. It's currently scheduled to be heard before the Court of Appeal, perhaps in 2017. So SDCERS stands ready to assist the city and its labor force with whatever assistance they need to help get that issue resolved. Another issue that's been in the news is the Public Employees Pension Reform Act, which was a California state measure that was implemented in 2013. This puts newly hired airport members and Port Authority members into a slightly leaner pension plan tier as well. And while we haven't seen many legal challenges to that initiative here in San Diego, it has been challenged in several other locations around the state of California. In fact, just last week, or a few weeks ago, there was a ruling in Marin County in Northern California on PEPRA. So it's still being challenged. So I expect that not only will pension reforms that have been enacted continue to be challenged, I think that we're going to continue to see this for a while. So we remain very engaged in following this and making sure that we're doing everything we can to keep the pension on a good footing. So, boy, this is a bit overwhelming. What's a member to do? Well, first of all, I want to thank you for coming here today because that was a smart thing for you to do. You've heard today that our pension system is very well funded. You've heard that our asset management by Liza is achieving national awards. I really believe your pension system is on the right road to ensure that your system remains sound. But what else can you do to make sure that you're feeling good about your pension system here? Well, read what you can. Find whatever you do find in the news, read about it. Ask questions about it. Stay engaged. Come to meetings like this. Join retiree organizations. There's the Retired Employee Organization, REA. There's the Retired Fire and Police. The Local 127 organization has a retiree group for them as well. come to those organizations as well, and you'll be just better equipped to be dealing with questions that people may ask. So that really concludes my prepared comments, and now I'd like to see what kind of questions you all have. So I'll bring Cynthia back up.
Thank you, Mark. And thank you to those who have submitted several questions here. We'll go through those now. I am going to start with Liza Kristofi with a follow-up on the investment questions. Liza, in a rising interest rate environment, where will pension funds be invested in the future?
That's a good question. As you know, interest rates are currently very low. And of course, there's a common perception that at some point interest rates are going to rise. And when interest rates go up, again, remember, if rates go up, that means prices are going down, which generally speaking means you lose money. So we've been anticipating this for the last couple of years, and what we've done is we've actually shortened the duration or the average maturity in the bond portfolio. Because if you're in shorter maturities, when that happens, you don't have very much of an impact. So we'll have to see how that plays out. The Fed is probably going to start raising interest rates. They're hopefully going to do it in a slow, measured fashion so that it doesn't create any shocks for the market. And as that happens, then what we can do in our fixed income portfolio is extend those maturities and actually invest at higher interest rates. So that's actually an opportunity for us.
Thank you, Liza. Now I have a question for Marcel. This is related to healthcare, and I'm glad that people ask their honest questions because this is a good question. Wanted to let you know that on Wednesday of this week, we had a Medicare 101 session right here in this very room. It was very well attended, and it was a very useful presentation. We will be doing that again. We get a lot of questions about Medicare, all right? This question is, do I lose my city health insurance once I join Medicare?
Excuse me, I want to add one thing to what Cynthia said. The slides from Wednesday's presentation will be on our website as well, so there's a lot of good information on Medicare. When you turn 65 and you become eligible for Medicare, please go ahead and sign up for Medicare as soon as you can, and you do not lose your health insurance. We offer several plans that are Medicare plans that you can enroll in through SDCERS, and those are available to you as soon as you turn 65 and complete your Medicare enrollment.
Thank you very much. A question for me. Cynthia, here's the question. How can I check on my retirement account? I've left employment, but not yet retired. Well, I can answer this question whether you're actively working, whether you have left employment, but not yet retired, or even if you are retired. If you go to the SDCERS website, at sdcers.org, we have a feature that is called a member portal. I'm sure many of you have this feature for your bank accounts or other type of services that you have, where you can create a secure login, and then you can access your personal account information. You can go in, create that, and look at the balance that you have and numerous details on your account. Update your address, and do a number of tools. If you're retired, you can update your tax withholding and your direct deposit and print out documents that are there. Now, if you don't want to do that, I still encourage you to do so. But you can also call our phone number, which is 619-525-3600. And I want to point out that active members, I see a number of you out here in the audience, thank you for coming. Park and Recreation, Development Services, thanks for coming out today. You are going to be receiving in the mail, if you are not yet retired, you're going to be receiving what we call a member statement in the mail. And that is us saying, hello, remember that SDCERS exists. We want you to be aware of your future benefits. It will have those basic details on there for you as of the end of the fiscal year. And it will also direct you to where you can find all of your information on the website. But we really like to reach out to our members. Sometimes folks left the city 20 years ago and haven't paid much attention, but we want to take care of everybody whose money we are holding and investing. So again, member portal on the website, you can give us a call, and folks who are not yet retired, look out for those member statements. All right? Now, I'd like to turn over a question to Mark. Mark, would you mind reading the question that is on the card there for me? Let's start with that one. Do you mind reading that for me?
Absolutely. So here's a question. If Proposition B is overturned, will the cost to employees be reduced with more people into the retirement fund? That's a very good question, and it's a little different than what I get asked frequently about how contributions might be affected with retired employees. Active members typically pay contributions only, not typically, they pay contributions just for their own benefit. So the reduction of fewer members in the system through Proposition B does not really affect any kind of retiree funding or calculation because everyone pays for their own individual retirement benefit. So I am not contributing more or less if Marcel is or isn't in the plan. I'm contributing just for my own benefit with investment earnings. So I probably could have answered that more succinctly, but the answer is no. If Proposition B is overturned, more people into the system won't reduce or affect the contributions that Marcel or I are currently paying into the retirement system or any other active member.
Thank you, Mark. Let's follow on that theme. There is a question on the larger sheet over there that I'll ask for you. We did have a question. Please provide an update on the purchase of service credit lawsuit that was filed 9 years ago, I believe now.
Yes, very long time ago. So just as a brief recap here, in 2007, the city of San Diego actually sued SDCERS requiring that we correct approximately 2,000 underfunded purchase service credit contracts. And SDCERS fought that in court for a long period of time, from 2007 to 2010. We lost that at the Superior Court level, and we also lost that case at the Appellate Court level. So in 2010, SDCERS was required to correct this underfunded contracts for about 2,000 people. Some of you may have been impacted by that. Very difficult process. So in 2010, we began the process required by the courts to correct that underfunding. And as you might expect, there were a good number of these 2,000 people that were affected that felt that was the wrong thing to do, so they also sued SDCERS. So for the last 6 years, from 2010 until now, we have been fighting that issue in court. And for about 90% of the matter has been completely resolved. SDCERS actually prevailed in both the Superior Court level and the Appellate Court level, meaning that we were correct we were acting appropriately in correcting these accounts. There is still a small group of people, police safety members, who are involved in a lawsuit on this, and we are still working through the court system on this. So Cynthia was correct in that it's a 9-year history, and it's not completely over yet. So I think we will all feel much better when this completely gets resolved.
Thank you. Now this question is for Liza. It relates to Proposition B. How is the fact of a closed pension plan to city employees affecting the risk review and asset liability study?
That's something that we're keenly aware of, and we've been on a schedule where we do an asset liability study every 3 to 5 years. And since the plan is partially closed, we have committed to doing that every 3 years. So far, it has not had an impact in terms of making any changes to the 78-22 mix of return-seeking to risk-reducing assets. That being said, that's something we're going to review very carefully going forward every 3 years, and at some point in the future, it is going to have an impact. And we're probably going to have to make some changes to the asset allocation, because some of those alternative investment classes that I was talking about, those are illiquid assets. That's money that's tied up for 10 years or more. And so we will have to review that in light of a shrinking pool of assets and look at our liquidity needs and make adjustments.
Thank you, Liza. I'm going to continue on that same theme, and Mark, this is for you. It's a bit of a follow-up to the question you answered previously. SDCERS has an actuary who does very important work to make sure that this fund remains solid and healthy. What is our actuary projecting will happen to our trust fund with the closure of the plan? Wondering, will the trust fund begin to decline as a result?
A slide in my presentation showed that the asset value of SDCERS is currently at about $7.1 billion. And despite the fact that the plan is partially closed, we have still over 8,000 active members into the system. Plus, the city is busily working on paying off their unfunded liability, which I said will take about another 12 years. All of that generates a considerable amount of cash coming into the pension system. Our actuary is projecting that our fund balance will continue to grow for about another 10 years. So if we're at $7 billion now, roughly, we are projecting that if we hit our assumed rate of return over the long haul, that will be around $10 to $11 billion at our highest point. And presuming Prop B stays in place, then eventually we would get a little bit smaller. But we'll get bigger for another 10 years or so.
Thank you. Now, this question is again on Proposition B, and I think we've come close to answering it, but maybe I was reading the card. So I'm going to repeat this one because this is very important to folks out there. If Proposition B is overturned, will the cost to employees be reduced with more people joining the retirement system again?
Actually, I fumbled that question a little bit earlier.
Second chance.
Let me try this one more time. The actuarial funding model has every employee paying in contributions that are appropriate for their own pension system. So I'll pick on Marcel here again. The contributions that Marcel is paying into the retirement system, plus the contributions that the city pays to match that, plus the investment earnings, fund Marcel's benefit. Whether I'm in the pension system or not doesn't really impact what Marcel will pay. So if Proposition B is overturned and more people come back into the pension plan, it has no impact on what Marcel needs to continue to pay, who has been in the system all along.
Thank you. We have 3 more questions. I'm going to handle this one. This is a question regarding health benefits and how and when could someone add their dental benefits. So just a reminder that open enrollment for city retirees occurs in the month of June unless there is a qualifying event such as you have a child and you need to add that child to your plan. So if you have questions about that, you can call us up or look on the website, but always be looking for this beautiful health book that we send out to all the city retirees in late May. We always let everyone know loud and clear that when open enrollment is happening and we have outreach events to provide additional information for you. Okay? Then, this question is for Marcel. Marcel, what is the drop annuity interest rate and how often does it change?
There are 2 interest rates that are associated with drop. So while you're actively in drop, for those members that are eligible to enter drop, there is an interest rate that is applied to your drop account balance. That rate is currently 1.7%. Once you exit drop, then there is a different rate that's used if you choose to annuitize those contributions. So if you choose to take your drop monies over 20 years, there's a different rate, and that rate is 3.0%. The rates are reviewed every year, and at our November 4th board meeting, staff will recommend whatever adjustments are necessary to the drop rates based on the formulas that we use to calculate them. The interest rate can change every year. The drop annuity rate, once you start getting an annuity of those benefits, once you start getting that 20-year pay, that's not going to change, even if we do change the rate for future people exiting drop.
And Marcel, just a follow-up to that specific part, if someone has retired from drop and is receiving a monthly annuity of their drop funds, if that member passed away, would any part of those funds transfer to the member's beneficiary?
Yes, your drop monies do go to your beneficiary. It doesn't have to be the same person that you may have named as a continuance of your retirement benefits. So if you've named your spouse as a continuance of your retirement benefits, you could name your child, your sister, your best friend, your mother as the beneficiary of your drop monies, and they will get the remaining balance of your drop monies.
Thank you. Mark, do you have a question there, or would you like me to move on this?
I do have a
Well,
question.
please go right
here.
ahead.
Is the city now required to pay off the unfunded liability, or may the city stop paying again? The city municipal code does require the city to pay their full pension bill each and every year. So they've been doing so for 12 years. They are obligated to do so. I expect them to do so, and we are going to hold them to that. I'm not concerned about the city not being able to pay their pension bill or their commitment to doing so. I think the mayor and the council have repeatedly and strongly affirmed their intent to continue paying the pension liability off.
Thank you. Are we ready for my last question here? Last two. This is for Marcel. This is regarding Medicare benefits again, okay? Do you have to join Medicare? And if you don't, what happens to that person's medical coverage?
That's a fairly complex question because it depends on what level of health benefits you are eligible to receive. You should join Medicare when you turn 65. There is a significant difference in the cost of insurance for Medicare-funded plans and non-Medicare funded plans. If you are one of the retirees who retired before April 1st of 2012 and are receiving an allowance to pay for your benefits, that allowance will be slightly reduced once you become eligible for Medicare. So highly encourage you to sign up for Medicare once you're eligible. You can sign up 3 months before you turn 65, the month you turn 65, and 3 months afterwards. And if you have additional questions, excuse me, on what's available, you can call our call center and they'll send you over to our health team. You can also go on our website and look at the healthcare book that Cynthia showed you a few minutes ago, which details the costs of all the different plans.
Thank you, Marcel. Now, I have saved this question for last because it's a nice closure here. Asked by a friend of mine over there. Thank you. The question relates to, can SDCERS do a better job of explaining to the media good things about the pension system instead of just being beat up all the time in the media? I have a couple responses to that. First of all, recent coverage that we've seen has actually been fairly balanced, and I appreciate that. We work very hard to educate the reporters that contact us. That's an important part of Jessica's job and of the executive team here. In a recent article that was published about the payment of the annual bill, our president, Alan Arolato, did an excellent job of explaining the importance of how the system is solid, and we've gone through reform, we're excellent in governance, and just explaining to people that while there may have been difficulties in the past, we are very much on a solid path, as we've described to you today, to make sure that things are in order. Now, second part of that is join a retiree organization. The retiree organizations are very well informed, and they are working in partnership on this concept of letting people know what is good about the pension and how things are funded and what is responsible about it all. The groups even have information published on their websites that answers questions. So if you're out at a barbecue and somebody starts asking you questions, do you have that answer ready? I hope today's presentation has helped you with that. Please review this if you can afterwards, if that helps you come up with a good answer, or join one of your retiree groups because they can help you feel informed and able to answer that question well. So our job here is to administer this fund and make sure that your benefits are secure and there for you for the rest of your life. We are also here, when we are asked questions from the public or the media, to absolutely answer those questions honestly and to provide the information that is needed. So please join us all in sharing the important messages that we have to share and in continuing to be informed. You've done a great job of that by being here today. I'd like you to give yourselves a hand first. Thank you. And if you have any questions, please speak to your retiree group representatives or let us know. Thank you all. Nice to see you.